All right. Well, welcome everybody. Thanks for joining us tonight. I'm Mark Curry, co-founder of SMK Capital Management, and I'm here with Dan Valenti, our portfolio manager. We're going to be spending about 15 to 20 minutes or so reviewing our Houston tax exempt apartment opportunity. We are going to go through just the main points tonight. We want to keep it relatively short and leave enough time for questions. So I would encourage you, if you haven't already, to log into our website. You can review our executive summary there. It's got a lot more detail and information. You can also listen to an overview of this investment with our operating partners and get a lot more information on them and their track record as well. So for this investment, we are projecting to provide our investors with an average annual return of 17 to 20% over the life of the investment. And we're going to share with you a lot of the details on how we're going to get there in just a second. Before we start, there's a chat button at the bottom of your screen. If you have any questions while we're going through anything, go ahead, type them in there, direct them to Dan, and we will go through everything at the end. Okay, so as we all probably know, the United States is facing an unprecedented need for affordable and workforce housing. Middle income residents, these earners are often priced out of new buildings like the property we're going to talk about tonight, especially in growing markets and in today's era of rising rental rates. So it comes with pleasure to me to provide our investors access to a very unique opportunity to invest into a 215 unit affordable tax exempt apartment community in Houston. Now, this property is going to provide affordable housing to the local region, and the investment is designed to provide investors with a very stable stream of passive income, capital preservation, and appreciation. So we feel that we really have a win-win structure here. Now, the property is a Class A property and location. And some of the unique features here, it was built in 2015. As of this morning, it's actually 98% occupied. There are only 4 vacant units. It's located in a very high demand submarket immediately south of downtown Houston. And this submarket has actually seen a 50% population increase since 2012. So a high demand, to say the least. Obviously, we can see that with the occupancy and the population growth. Now, this market also has an average household income near $120,000 annually. Okay, I want to run through some of the amenities and features of the property that make it quite attractive and obviously Class A style property. So first, you can see the location in this photo, obviously downtown Houston, right behind the property. You've got high rises, so very well located in an urban area. And you can see here pretty high quality construction. It's 5 stories, has several elevators and underground parking garage as well. Now, the property sits directly on the Metro Red Line, which you can see here right outside the building. This train runs north and south through downtown Houston. It actually carries 55,000 passengers daily, and it's one of the nation's most traveled rail lines. Again, a very attractive highlight of the property location. Here we have a beautiful private resort style pool. We also have a dog run for pets. And you can see the large open lobby and office area, very tall ceilings. And there's a high-end common area here with a lounge and a bar feel. It's got residents are able to hang out right next to the pool. You see here on the next picture, attractive fitness center. We've also have a pretty cool game room with a pool table. So some of the amenities that make this property really attractive. Now, when we look at the interior units, you see an open living area, very nice kitchen concept with the island, granite countertops, stainless steel appliances. And on the next picture, we've got here recessed lighting and very tall ceilings. They're either 9 or 10 feet. And so Very attractive, modern design, beautiful property in and out. Now, normally this type of Class A property, so close to downtown, such new construction, wouldn't really meet our investment criteria because a lot of these properties typically don't produce much cash flow. And these assets are often bought by institutional investors, insurance companies, pension funds. A lot of their focus is not on cash flow. It's a bit more maybe on capital preservation and lower risk. But we have a unique structure here where we can invest in this beautiful property and earn cash flow and a great return. And we're doing that through the property tax exemption structure. And what this is our operating partners will be entering into a joint venture with the housing authority to purchase the property and provide affordable housing. So in exchange for rent and income restricting 50% of the units, the property qualifies for a 100% property tax exemption, which is good for 99 years. And this saves us in year one over $970,000 a year in real estate taxes. In addition, if we look at it on a financial analysis standpoint, we're able to reduce our expenses by over 45%. And that's obviously a very good way to reduce risk. And this property tax exemption is fully transferable to future buyers. And we'll dive a bit more into this in a minute. But for now, let me have Dan go ahead and give you an overview of some of the other key investment benefits.
Thanks, Mark. Good evening, everyone. So let's talk about why we feel this is an attractive investment. And the first and main reason really is that the structure immediately increases NOI and free cash flow. So it provides investors with a very attractive risk adjusted return, while also providing the need of affordable housing in the region. So there's certainly demand for this product. The partnership is created while in escrow and takes effect once we close on the deal. So again, to reiterate, the significant value creation here is with the tax exemption, and that's being realized at acquisition. And one way to really see that is through the appraisals that we've received from an independent third party. And so our purchase price is $45 million, which equates to a going cap rate of over 6%. As is, it's appraised slightly better for $49.4 million, but with the tax exempt structure, the appraised value is actually $76.3 million. So you can see there that that spread between the purchase price and the appraised value after putting this tax exempt structure in is very significant. And just to kind of put that in perspective for what that means for our investors is, you know, when we modeled this out and sell the property in year 5, we're only modeling the sale price to be $65.6 million. So we do feel we're being somewhat conservative here. In addition, by having this affordability structure, we were able to obtain more favorable financing terms. And for investors, cost segregation and bonus depreciation are expected to provide passive K1 losses in year 1 between 80 and 100% of their investment amounts.
Thanks, Dan. I just want to go back for a second and kind of stress the uniqueness of this, right? You look at the purchase price and these appraised values, and we'll share some comps in a minute as well, but we really feel that the going in price here and the basis is very attractive. And this isn't something we see very often. We've been in this business for many, many years. To see this kind of spread between purchase price and appraised values, it just really helps us reduce risk. I think the tax exempt appraised value is high. I don't know that anybody would pay that today, but nonetheless, you can see that the value here is being created the majority of it at acquisition. And Dan will dive in a bit more on some of the other areas of valuation growth as well. But again, very unique structure, not a common structure to have where this huge variance at the start of an investment.
Thanks, Mark. All right, so let's now talk about our financial projections. Due to our relationship with our operating partner on this deal, we were able to negotiate favorable terms for our investor group, and that includes a higher preferred return and higher split above the preferred return. And for this offering, we are providing 3 share classes with 50, 200, and 500K minimums respectively. Over a 5-year hold period, we're expecting this opportunity to produce between 14 and 17% IRR and a 17 to 20% ROI. Our annual management fee is 1%, as well as a acquisition and disposition fee of 1% as well. We expect this investment term again to be 5 years, and plan on paying distributions quarterly. Projected annual cash flows will be between 7 and 8% on average. And specifically, if we look at year 1 and year 2 at 5 to 7%, it's almost unheard of to hear of these kind of cash returns in year 1 and year 2 for a Class A asset. I mean, I can't, in this recent environment of low interest rates, I can't remember ever having seen that.
Yeah, it's definitely rare, Dan. It's a big appeal for us to be able to start out really strong cash flow on, Class A downtown 2015 build. They don't typically go together. So it's a great advantage that we have here.
Up next, these are the financial projections for the property. And as of our check this morning, Mark spoke about this, occupancy stands at 98%. And we are projecting in our model only 94% occupancy. So lower than where we are right now. And just another point of reference, our operating partner, their affordable housing portfolio nationwide is roughly 97% occupied.
And just to add one more point to the occupancy, the 94% that we're projecting is a blended occupancy between the market rate units and the affordable rate units. And so the average between those two is 94%. So we feel that there's a pretty good buffer there between what's actually going on and the demand for the asset. And of course, our operating partners' track record and portfolio on these types of properties.
Yeah, also a blended rate here is 2.8% for organic annual rent growth. And that is below sub-market forecasts for the next few years. Also rarely do we see operating expenses in the range of 30%, which you can see here. You look at net revenues in year 1 of 4.3 million versus total expenses of 1.2 million. And what that cushion does is basically it opens up free cash flow, and that reduces investor risk.
Yeah, there's just a ton of margin here, guys, I think is the main takeaway when you're looking at operating expense ratios. And we look at this pretty closely. Most apartment communities, especially this type of class, you'll see 50 to 60%. And so there's just a lot more meat on the bone here, obviously, because of the tax exemption. And so this is just another favorable advantage starting in year 1.
Yeah, and another point to mention is that there is a CapEx budget of 1.075 million or $500,000 $5,000 a door on capital improvements. So as we do with all our deals, we ran a stress test to get a feel of how the investment will perform under extreme conditions. And in this case, the property can absorb 27.5 vacancy and still make its debt payments. Also, assuming that rents do not increase over the hold period. Again, a very conservative assumption, especially based on demographic trends. Investors will still earn a 5.3% cash on cash return.
And that's really rare too, gosh, assuming no rental growth at all in investment, I don't know if have we ever seen an investment, Dan, that we had no projected rent growth? A lot of stuff we do and focus on is value add. And so the goal is to insert capital into the property and grow rents. And so here we were just trying to look at what we think is maybe a worst case scenario. If rents don't go up at all, how does it affect returns? And still having a positive, 5% plus cash on cash is just really attractive. So downside protection, very strong on this deal compared to most other investments that we see today.
Right. On the other side, we have the aforementioned debt, and the affordability structure of this deal allowed us to get some very favorable terms. For example, the loan amount is 76% loan to cost. We have a lower fixed interest rate of 4.94%, and we have a longer term of interest only payments lasting 7 years. So the benefits here are obviously the fixed rate reduces risk of rising interest rates in terms of debt payment, debt service, and the longer interest only term provides greater cash flows throughout the whole period.
Thanks, Dan. Yeah, a lot of deals we're seeing today, guys, 65% loan to cost. And so we have an advantage here to be able to still, very conservatively leverage the property, but also take advantage of some very attractive financing, all things comparable to other deals and rates out there today.
Yep. Here we're looking at a breakdown of our market rents units, which are well below comps. So as you can see, the submarket rents in the area are $1,819, while in-place rents are $1,649. So that 10% difference, the loss to lease, provides an opportunity to raise rents to market in year one, which along with the tax exemption is the crux of the business plan. Mark, do you want to go over the affordable units?
Yeah, sure. Let's dive in. So as Dan noted, 50% of the units he just shared with you are at market rate. The other half, 108 units, will be rent and income restricted. That's based on area median income. And you can see here the in-place rents and then what the rents would be. And so we are going to be reducing the rents on these units. That's going to result in a revenue reduction of $217,000. Obviously, that's greatly offset by the property tax savings of $977,000 in year one. And important to note is that savings is based on the seller's assessed value today. It's not, we're not looking ahead at to what value most likely will be and what the assessment could be down the road. And Texas reassesses frequently. And so the savings we feel today are probably on the lower end of where they'll be in the next several years as well. An important point here, a lot of people ask is regarding these rent restricted units, can they go up? Do they go down? Are they fixed for life? And the answer is they increase annually based on the area median income. And so area median income is published annually. And you can see in the chart here for the last 10 years, the area median income in Harris County, where the property is located, has been steadily increasing up and to the right. And so the rental units on the affordable units would also increase with area median income as well.
That's right. Let's take a quick look at the Houston market overall. So I'm sure everyone here is familiar with Houston, but it's a massive market and it's growing. And we can see the growth in this chart on the bottom right. It's the most populous city in Texas and the fourth most populous city in the US. And it has 7 million residents. Over the next decade, that population is expected to grow to 9 million. So the fact that it's well known for being one of the largest energy hubs in the world has helped drive tremendous in-migration from other parts of the country. And not only is the population large and growing, but it's highly educated and home to more engineers than any other US metro. So going back to that income number, that's a pretty important stat there.
Yeah, thanks, Dan. If we look at this map, guys, you can see kind of an aerial shot here. The property is located where that green star is. And that red line, you see, that's the metro rail. So right in front of the property going north and south through downtown. And the property is walking distance to Starbucks, Whole Foods, Chipotle, all within the neighborhood. So really attractive location here. Let's shift gears. I want to talk a little bit more about the basis. These are the sales comps. And what you'll see here is the year built is an average of 2016 across these 8 comps. The price per unit is around 290,000 on average, and we're buying at 209,000 per unit. In addition, the price per foot on average is 307, and we're acquiring for 245. So we really feel quite happy and excited about the basis and the purchase price of this property. Obviously, that was reflected in the appraised value as well. Even as is, it was 10% below appraisal, give or take, and obviously significantly below the appraisal once we take into account the tax exemption. So just excited about the basis here, especially when we compare it to the neighboring properties in the area. Again, these are all Class A, new construction, very similar property to what we're buying here. Quick overview on our operating partner. You can learn a lot more about them, review their track record, listen to an interview. But in short, they currently manage a little over 17,000 units. This chart's slightly outdated. They have a lot of history in affordable acquisitions. They've had 32 properties go full cycle and sell. They've delivered an average return of investment of 2x, or doubling investors' money, and a 32.99% average IRR. So very strong track record, expert in these affordable properties. In addition, at the bottom here, you'll see that they've on 18 separate occasions been able to return investors' capital and still have everybody remain in the deal. That's typically done through a refinance or a supplemental loan. And, we love this strategy today. There's a potential for this to occur at this property. We don't underwrite to it. We don't tell people to expect it, but obviously it's a very important strategy that we like to see. The option is potentially there. And this property could be a potential candidate for a supplemental loan down the road as well. And so we like to see that. Something else to note about these types of assets. Okay, this is kind of a snapshot from our executive summary. We've got some frequently asked questions here. We'll just review a couple that we constantly get asked, but when do distributions start? We're projecting the property is going to close. Actually, the close date is October 24th. And so the first distribution would be after the first full quarter of operations and ownership. So probably around February or so. The next question is, when does the preferred return begin to accrue? That starts again, right when the property is acquired in the end of October there. So in summary, we find this asset to be very unique. We're able to invest in a high quality property in a very strong submarket in a downtown location and provide affordable housing. And so we find that to be a win-win. We feel that there's a lot of de-risking in this deal when it comes to the asset, when it comes to the financials. I'm very excited about it. This is quite a unique investment. We look at a lot of deals, and we've been really sharing this one with folks lately because we believe wholeheartedly in it. So that's a bit of the summary on the deal. We've got 3 different class shares here on the screen that you can see, as Dan had previously noted. You can go ahead and log in at our website to view more information and to subscribe or invest in the offering. And a couple dates that will pop up on the screen here. We're we're asking, we've actually already started accepting investors' capital last week. And subscription documents, we're asking people to complete them by the 3rd, which is next Monday, with a funding deadline of October 14th. So I think at this point, Dan, why don't we open it up to questions and answers? I appreciate everybody's patience as we run through the deal. We did have some folks email questions ahead of time. Dan, do you want to start with some of those, and then we can take any that came in through the chat as well?
Yeah, I think it would be helpful to go back to our FAQs because we did receive a question on kind of the affordable units as well. So basically, let's just go over these top 2 questions. How much does rent need to be discounted from current levels to meet affordable housing guidelines? And so again, we're earmarking 50% of the units, or 108 units, to be rent and income restricted. And the rent will be based on the area median income. 40% of the units will be rented to residents earning 80% of that area median income, and 10% will be rented to people with a 60% AMI. The remaining 50% of the units will be at market rates and unrestricted. So again, as Mark spoke about earlier, when we look at what are we giving up and what are we getting, our analysis shows that although we are reducing rents on the affordable units and decreasing revenues by $217K, we have a large loss to lease on the market rate units that will make up for part of that, as well as the gigantic tax savings, which currently is $977,000 annually. So that's kind of what's creating this large pickup in NOI and creating a lot of value on day one.
Yeah, good point, Dan. I think to also just to clarify that 50% of the units will be rent restricted, and 40% of those will be at 80% of AMI, right? So that's 108 units will be rent restricted. So roughly 40 of those will be rented out to those that make 80% of the area median income, and 10%, 40% of the total, 10% of be at 60%. So if that's confusing, let us know. But this is explained in the FAQs and the executive summary as well.
Right.
Why don't we go on to the next question, Dan?
And yeah, just as we showed earlier in that chart, the 2022 AMI for this county is about, for one person, is $63,000. So.
Okay, yeah. So 80% of that, is what somebody would have to earn. So roughly 48,000. And then 60% as well, 10% of the units. So 60% of 60,000, right? 36,000. So those are kind of the qualifications for the rent restricted units. And to add to it, people still need to qualify. They have to fill out an application. They have to be able to show enough income to support paying the rents, right? This isn't subsidized housing. It's not Section 8. We're just reducing the rental rate for these residents that make a little less than the area median income, as you can see here.
That's right. The follow-up question to that was, who is the seller, and did they not have tax exempt status?
Yeah, I'll take that one, Dan. The seller did not have tax exempt status, and this tax exempt status is being created in escrow as we speak. It was approved a few weeks ago, which is required for the debt to be locked in, because we're getting special financing. This is either Fannie or Freddie loan that is allocated specifically for affordable housing. So they have special financing programs for these types of properties. The seller is an institutional group. I believe they built the property in 2015 and have owned it since, but it is not currently tax exempt. It will be once we close on it at the end of October.
How are you accounting for the risk of rising interest rates?
You want to take that one, Dan?
Sure. So the first thing is we are funding this with fixed rate debt. So regardless of where interest rates go, we know our debt service. And in addition to that, rising interest rates could push up cap rates. And so in response to that, we're baking in 80 basis points of cap rate expansion when we go to sell the property.
Yeah, just to add some color there. So the going in cap rate as is without the tax exemption is 4.45%, which we find to be actually pretty attractive for this type of property in this location. And then when we model it out, we're actually projecting the sale, the exit cap to be 5.25%. So you've got a 80 basis point cap rate expansion built into our numbers. But the going in cap rate, once we put in the tax exemption, as we showed earlier, is actually 6.32%. And so a lot of the deals we're looking at today, what we're trying to find is a variance, a delta between the interest rate and the going in cap rate. And with interest rates climbing as they have so quickly this year, we've found that difficult to find. And here we have an interest rate of 4.94%, and you have a tax exempt going in cap rate of 6.32%. So we have a very nice spread there that we like to see. Again, really helps reduce risk, especially in today's volatile interest rate market.
Are you concerned at all about storm risk?
I'll take this one, Dan. Yeah, I mean, we are. We've experienced storms. We all have. They're more frequent. I'll share this. I've got family in Houston, and Dan and I are going to be visiting the property on Tuesday. But I remember in 2017, Hurricane Harvey came through Houston. It was probably the worst storm they'd seen in decades. And obviously, I got a firsthand look at that through my family who was there at the time. But what we ended up doing on this property to get a better feel for the risk here, first of all, it's not in a flood zone. Second of all, we have very adequate insurance, flood insurance, loss of rental insurance, et cetera. And we also went back and requested from the seller 5-year loss runs. So we looked at all insurance claims on the property since 2017 and also asked them directly, of course, what happened during Harvey. And there was no insurance claim, there was no flooding and no damage at the property through Hurricane Harvey. So there's always a risk, but we found that doing some homework on this property and this location and looking at the loss runs with the high quality construction, the construction standards in 2015, especially in this part of the country, are often built to be able to withstand very high winds and storms. And so seeing that the property's been through this before, it was a Category 4 hurricane and didn't weather any damage was very comforting for us. So that's kind of how we look at it. But nonetheless, very well insured. And we find that this property is probably going to be very well built to withstand a storm if and when one happens.
Okay, I think that's it from.
Any more questions, guys? I had a couple come in, Dan. Maybe if people want to chat or write anything else in the chat, they can. I had a few folks email me ahead of time. They couldn't make this meeting, but they wanted to ask some questions. So let me pull those up real quick. So the first one was, can I invest through a self-directed IRA? The answer is yes, you can. We have a lot of investors that do that. The second one was, if I invite 2 friends and a family member to invest and our total is in the Class B range, can you allocate Class B to each of us? Okay, got it. Yes, we can do that as well. We would just ask that you let us know who all the parties are, of course, and so we can internally kind of group them together for the higher class investment, minimum investment. Any other questions today from anybody? Dan, if there anything else pops up, let me know, but maybe we'll give it another second here.
Okay. No.
Oh, okay. Well, thank you all for coming out and joining us. I hope you found it helpful. If you want to look at more detail or subscribe, you can go ahead and log in on our website. And feel free to reach out to Dan or I if there's any questions we can answer for you. Thank you.
Thanks.